In 2022, the United States didn't fire a missile at Russia. It pressed a button. And that button may have done more damage to the US dollar than any war in modern history. Because when America cut Russia off from SWIFT, it didn't just punish an enemy. It exposed a terrifying truth to the entire world. Money is no longer neutral. And once money stops being neutral, no currency stays king for long. This isn't speculation. This isn't ideology. This is history repeating itself faster. Let me show you why. On February 26, 2022, just 2 days after Russian troops entered Ukraine, the US and the European Union announced what they called the nuclear option of financial sanctions. Russia would be cut off from SWIFT. To most people, that sounded technical, almost boring. But inside financial circles, it landed like an earthquake. Because SWIFT isn't just another banking system. It's the invisible infrastructure that keeps global trade alive. Over 11,000 banks, more than 200 countries, trillions of dollars in transactions every single day. Oil, food, medicine, technology, all of it moves through messages sent by SWIFT. And overnight, Russia was disconnected. No easy international payments, no smooth trade settlements, no normal access to global finance. Western media celebrated instantly. Russia would collapse, the ruble would implode, the economy would be strangled, Putin would be forced to retreat or fall. This was supposed to be decisive, clean, final. And for a moment, it looked like it worked. The ruble crashed. Russian markets shut down. ATMs ran out of cash. Panic spread. But then something happened. Something no one in Washington expected. Russia didn't collapse. In fact, the system designed to destroy Russia exposed a far bigger weakness. Because within months, the ruble stabilized. Trade continued. Energy kept flowing. Just not through Western channels. And that's when the real damage began. Not to Russia, to trust. Because every country watching understood the message. If the United States could freeze $300 billion in Russian reserves, if it could cut a major economy off from the global financial nervous system, then no one's money was truly safe. Not China, not India, not Saudi Arabia, not Brazil, not even close allies. And that realization quietly rewired global finance. Here's the part most people miss. SWIFT doesn't actually move money. It doesn't hold deposits. It doesn't approve transfers. SWIFT sends messages, secure instructions between banks that say, authorize this payment, confirm this transfer. Without those messages, global trade doesn't stop completely, but it becomes slower, riskier, and more expensive. And in finance, friction kills. SWIFT was created in the 1970s to solve chaos. Before it, international payments relied on telex messages, slow, error-prone, insecure. SWIFT standardized everything: speed, security, reliability, and over decades, it became invisible, which is exactly why it was powerful. No one planned for life without it, until Russia was cut off. And suddenly, every central banker outside the West asked the same question: what if we're next? Because SWIFT might be based in Belgium, but the real power sits elsewhere. Most international transactions settle in US dollars, and dollar clearing runs through New York. That gives Washington leverage, legal leverage, political leverage. And in 2022, that leverage was used at full force. This wasn't just a sanction, it was a precedent. And history is brutal with precedents. Because once financial infrastructure is weaponized, the clock starts ticking. And this is where economy rewind matters. Because this exact strategy has been used before, 4 times in the last century. And every single time, the outcome was the same: short-term dominance, long-term decline. The dominant power believes it has ultimate leverage. It weaponizes the system. The target adapts. Neutral countries panic. Alternatives emerge, and slowly, the original system loses its grip. Britain learned this lesson the hard way. So did the United States. And now, it's happening again, faster. But before we go back in time, understand this. This isn't just about geopolitics. It's about you, your savings, your currency, your purchasing power. Because reserve currency status isn't an abstract concept. It's what allows the US to print money without immediate consequences. It's what keeps interest rates low. It's what makes imported goods cheap. And when that status weakens, everyone feels it. Prices rise. Debt becomes heavier. Living standards adjust downward, not overnight, but permanently. In February 2022, the US believed it was using its greatest strength. In reality, it revealed its greatest vulnerability. Because financial weapons are like nuclear weapons. You can only use them once. After that, everyone builds defenses. And once alternatives exist, the original weapon loses power. We're not at the end of this story. We're in the middle, the most dangerous phase. Because the system still looks strong right before it isn't. In the next part, I'll take you back to 1914, to the British Empire, to the moment Britain weaponized global finance during World War I, and unknowingly started a 30-year countdown to losing the world's reserve currency forever. Once you see that pattern, you'll understand why the dollar's clock is already ticking. In 1914, Britain believed it had an unbeatable advantage. Not its navy, not its army, its money. Because before the First World War, London wasn't just a city. It was the center of the world's financial gravity. If global finance had a capital, it was London. The British pound wasn't just a currency. It was the reserve currency. International trade contracts were written in pounds. Global debts were settled in pounds. Central banks held pounds as the ultimate store of value. Britain controlled roughly 2/3 of global financial reserves. And that control felt permanent. Then war broke out. In August 1914, Britain faced a problem no empire had ever faced before. Germany wasn't just a military enemy. It was a financial participant in the same global system. German companies owned assets across the British Empire. German banks held accounts in London. German shipping companies operated through British insurance markets. For centuries, war had rules. Armies fought, nations clashed, but finance stayed neutral. Contracts were honored, assets were respected, money moved, even between enemies. Until Britain broke that rule. Within weeks of the war starting, Parliament passed the Trading with the Enemy Act. On paper, it sounded reasonable. In reality, it changed global finance forever. The law allowed Britain to freeze, seize, and confiscate German-owned assets anywhere under British control. Bank accounts, businesses, ships, property, all frozen, all seized, not because of bankruptcy, not because of default, but because of politics. For Germany, the impact was immediate and brutal. German firms lost access to global capital. German banks were cut off from London markets. German trade collapsed. In 1914, Britain believed it had an unbeatable advantage. Not its navy, not its army, its money. Because before the First World War, London wasn't just a city. It was the center of the world's financial gravity. If global finance had a capital, it was London. The British pound wasn't just a currency. It was the reserve currency. International trade contracts were written in pounds. Global debts were settled in pounds. Central banks held pounds as the ultimate store of value. Britain controlled roughly 2/3 of global financial reserves, and that control felt permanent. Then war broke out. In August 1914, Britain faced a problem no empire had ever faced before. Germany wasn't just a military enemy. It was a financial participant in the same global system. German companies owned assets across the British Empire. German banks held accounts in London. German shipping companies operated through British insurance markets. For centuries, war had rules. Armies fought, nations clashed, but finance stayed neutral. Contracts were honored, assets were respected, money moved, even between enemies. Until Britain broke that rule. Within weeks of the war starting, Parliament passed the Trading with the Enemy Act. On paper, it sounded reasonable. In reality, it changed global finance forever. The law allowed Britain to freeze, seize, and confiscate German-owned assets anywhere under British control. Bank accounts, businesses, ships, property, all frozen, all seized, not because of bankruptcy, not because of default, but because of politics. For Germany, the impact was immediate and brutal. German firms lost access to global capital. German banks were cut off from London markets. German trade collapsed. Britain celebrated. This was financial warfare at its finest. No battles, no bloodshed, just leverage. And in the short term, it worked. But here's what Britain didn't realize. It wasn't Germany that mattered most. It was everyone else watching. Because neutral countries not involved in the war learned a terrifying lesson. If Britain could seize German assets today, it could seize anyone's assets tomorrow. Your money in London wasn't protected by law. It was protected by British approval. And approval could be revoked. Quietly, rationally, neutrals began to act. They didn't protest. They didn't make speeches. They diversified. Gold reserves increased. Accounts were opened outside London. New financial relationships formed in New York, Paris, and Zurich. No panic. No headlines. Just quiet risk management. And that's how empires actually lose power. Not through rebellion. Through insurance. The United States was the biggest beneficiary. Before 1914, New York was a secondary financial center. Important, but not dominant. After Britain weaponized finance, capital started flowing west. Gold crossed the Atlantic. Trade financing shifted. Banking relationships relocated. By 1920, the U.S. held more gold than Britain. By 1925, New York rivaled London. By 1944, at Bretton Woods, the transition became official. The dollar replaced the pound as the world's reserve currency. Britain didn't lose dominance in battle. It lost it by weaponizing trust, and the timeline matters. 1914, Britain weaponizes finance. 1944, Britain loses reserve status. 30 years, that's the pattern. Now rewind back to the United States. Because America watched this history, studied it, understood it, and still repeated it. The second warning came in 1979, when Iranian revolutionaries seized American hostages. President Carter froze all Iranian assets held in U.S. banks, about $12 billion. At the time, it was the largest asset freeze in history. Again, it worked tactically. Iran was pressured. Negotiations followed. Hostages were released. But, strategically, the damage was already done. Because oil-producing nations saw something alarming. Sovereign reserves money earned through trade could be frozen instantly by executive order. Not by courts, not by treaties, by a phone call. And quietly, OPEC nations began diversifying. Dollar holdings fell. Gold holdings rose. Accounts spread across jurisdictions. The dollar didn't collapse, but trust weakened. Then came 2014. Russia annexed Crimea. The U.S. imposed sanctions. This time, something different happened. Russia wasn't cut off completely. No swift ban, no reserve freeze, just enough pressure to hurt, and enough warning to prepare. And Russia took that warning seriously. Over the next 8 years, Russia did something Western analysts dismissed as symbolic. It reduced dollar exposure. Massively. U.S. Treasury holdings dropped from $130 billion to almost zero. Gold reserves more than doubled. A domestic swift alternative ZES (PFS) was built. Trade deals with China and India shifted to local currencies. Putin said openly, "The dollar is a weapon." Western analysts laughed. Russia is too integrated. Decoupling is impossible. They were wrong. Which brings us back to 2022. When the U.S. didn't just sanction Russia, it froze $300 billion in central bank reserves. This wasn't a company's money. This wasn't private wealth. This was sovereign capital. And in that moment, every finance minister on earth understood the message. Reserves are conditional. And once that belief takes hold, the system changes permanently. Because money, above all else, runs on expectation. And expectations had shifted. Russia survived. Not because sanctions failed tactically, but because the world adapted strategically. trade rerouted, currencies changed, alternatives scaled. And here's the critical insight. It wasn't Russia that mattered most, it was the neutral countries. China accelerated de-dollarization. India expanded local currency trade. Saudi Arabia accepted non-dollar oil payments. Brazil, UAE, ASEAN, nations all hedged. Not because they hate America, because they watched history. And history was screaming. This is the 5-stage pattern. Control the system. Weaponize it. Targets, adapt. Neutrals, hedge. The weapon loses power. Britain did it. The US did it. And now we're in stage 4. The calm before the shift becomes visible. In the next part, I'll show you the data proving this is happening right now. Not theory, not prediction. Hard numbers. Dollar reserve decline. SWIFT, market share erosion. China's payment systems exploding. And once you see the data, one question becomes unavoidable. If Britain lost reserve status in 30 years, and technology moves 10 times faster now, how much time does the dollar really have left? For decades, the dollar looked untouchable, not because America was perfect, but because there was no alternative. That illusion is now breaking, and this time, we have the data. Let's start with the number that matters most: global reserves. In the year 2000, the US dollar made up over 71% of all foreign exchange reserves held by central banks. Today, that number is around 58%. That may not sound dramatic until you understand this. Reserve currency shifts are slow until they aren't. The British pound didn't collapse overnight either. It bled quietly, year after year, and then suddenly, it was over. What makes this decline different is speed. From 2000 to 2010, the dollar's share barely moved. From 2010 to 2020, it slipped gradually. After 2022, the drop accelerated. Not because of inflation, not because of debt, but because of risk. Central banks don't think like investors. They think like insurers. They don't chase returns. They avoid catastrophe. And in 2022, the unthinkable happened. Reserves were frozen. At scale, that single event changed the risk model forever. Now look at SWIFT. In 2015, nearly 90% of international payments used SWIFT messaging routed through Western banks. Today, alternatives are growing fast. China's SIPS system now processes trillions annually. Russia's SPFS links hundreds of banks. Regional payment rails are forming across Asia, the Middle East, and Latin America. Individually, they look small. Collectively, they form an exit ramp. And exits don't need to replace the system. They just need to exist. Because once an alternative is credible, monopolies lose pricing power. The dollar's dominance worked the same way. It wasn't chosen every time. It was defaulted to. And defaults change when risk appears. Now look at trade settlement. In 2010, over 80% of global trade was invoiced in dollars. Today, that number is falling. China settles most of its trade with Russia in yuan. India pays for Russian energy in rupees. Brazil and China trade directly in local currencies. Saudi Arabia accepts non-dollar oil contracts. Again, not ideological, pragmatic. Because if dollars can be frozen, they're no longer neutral. Now, here's the part most people misunderstand. This doesn't mean the dollar collapses tomorrow. Reserve currency loss isn't a crash. It's a tax, a slow, invisible one. As global demand for dollars weakens, America loses a privilege economists call exorbitant privilege. The ability to borrow cheaply. The ability to print without immediate inflation. The ability to run massive deficits without punishment. When that privilege fades, consequences appear. Interest rates stay higher. Inflation becomes harder to control. Imports become more expensive. Debt becomes heavier. Not suddenly, but structurally. And this is where it becomes personal. Because you don't need a currency collapse to lose purchasing power. You just need erosion. 1% here, 2% there, year after year. Until your savings buy less, your income stretches shorter, and your standard of living quietly adjusts downward. That's how reserve currency decline actually feels. Ask Britain. Now ask the harder question. Can the US stop this? The honest answer, only partially. Once trust is broken, it can't be unbroken. But damage can be slowed by restraint, by diplomacy, by making financial weapons rare. Again, the problem. Financial sanctions are politically easy. They look powerful. They avoid boots on the ground. They satisfy voters, which means they'll be used again, and every use accelerates the exit. This is the trap. The dollar's strength invites weaponization. Weaponization undermines the dollar's strength. A perfect feedback loop. So where does this end? Not with one new currency. Not with the yuan replacing the dollar. That's the wrong model. What's emerging is fragmentation. A multi-currency world. Regional systems. Bilateral trade. Localized finance. Less efficiency. More friction. Higher costs. For everyone. Especially the country that benefited most from the old system. And that brings us to the final insight. Reserve currencies don't die from enemies. They die from misuse. Britain didn't lose the pound because Germany beat it. It lost it because it turned trust into a weapon. The United States didn't weaken the dollar because Russia was strong. It weakened it by showing the world that dollars come with conditions. And conditions change behavior, quietly, rationally, relentlessly. We're not at the end, but the direction is clear. The financial world is preparing for a future where no currency is untouchable. And in that world, power looks very different. Less centralized, less absolute, and far more expensive. This wasn't a mistake. It was a choice. And like all choices in history, it came with consequences. The clock didn't start in 2022. That was just when everyone noticed it ticking. By the time a reserve currency actually falls, the decision has already been made. Markets don't wait for announcements. They move ahead of them. And right now, the global financial system is quietly repositioning. Not away from the dollar overnight, but away from dependence on it. This is the phase history almost never shows clearly, because it doesn't look like collapse. It looks like diversification. Let's talk about gold. When trust in currencies weakens, gold always tells the truth first. Between 2010 and 2021, central banks were modest buyers. After 2022, they became aggressive. The largest gold purchases in recorded history happened after Russia's reserves were frozen. Not by speculators, by central banks, China, India, Turkey, Singapore, Middle Eastern states. Gold has no issuer, no sanctions risk, no political switch. That's the point. Now look at bilateral trade agreements. Countries are rewriting contracts to avoid reserve currency exposure. Energy deals in yuan, commodity trades in local currencies, swap lines bypassing New York entirely. These deals aren't loud. They're legal documents. And legal documents outlast headlines. Then there's infrastructure. Payments aren't just software. They're plumbing. And the plumbing is being rebuilt. China's SIPS isn't trying to replace SWIFT globally. It doesn't need to. It just needs to work regionally. So do India's UPI links. So do Middle Eastern clearing systems. So do BRICS settlement proposals. Fragmentation isn't efficient, but it's safer. And safety beats efficiency when trust is gone. Here's the uncomfortable reality. The US can't sanction the entire world. At some point, the marginal cost becomes too high. And once alternatives reach critical mass, financial weapons lose their shock value. That's when leverage evaporates. This doesn't mean America becomes weak. It means America becomes normal. Subject to trade-offs. Subject to constraints. Subject to consequences. Just like every other country. That transition is painful because the dollar's dominance subsidized American life. Cheaper imports, lower borrowing costs, global demand for US debt. When that subsidy fades, something has to give. Higher taxes, lower spending, or inflation, usually all three. Now here's the final mistake people make. They look for a villain. China, Russia, BRICS. But history doesn't work like that. Britain didn't lose the pound because America attacked it. America didn't lose gold convertibility in 1971 because enemies forced it. Reserve currencies fail from internal decisions, overreach, short-term thinking, weaponizing advantages meant to be preserved. And this brings us to the final question. Could this have been avoided? Yes, by treating financial infrastructure like nuclear weapons, used only in absolute emergencies, never normalized, never routine. Because once the world sees the blast radius, it starts building bunkers. And once the bunkers exist, the weapon is no longer decisive. The United States still has immense power, military, technological, cultural, but financial trust is different. It's slow to build, fast to lose, and almost impossible to fully restore. The dollar won't disappear, but it doesn't need to. It just needs to matter less. And when it does, the world becomes more expensive, more fragmented, and more unstable. That is the price of weaponizing money. Not today, not tomorrow, but inevitably. History is clear. Empires fall when they confuse power with permanence. The dollar's story isn't finished, but its era of unquestioned dominance is. Once you see that pattern, you start noticing it everywhere. Quiet moves, small shifts, rational decisions. The end of a system never sounds like an explosion. It sounds like paperwork.